The 5-year Treasury started the week at 3.99% and the 10-year at 4.09%. Now, last Friday, core PCE came in at 2.9%. That's the lowest we've seen in nearly 3 years. We were at 4.9% this time last year. So that's a 2% drop in the last 12 months, which means we have 0.9% to go to reach that 2% target. And if you look at the monthly data, we've already hit 2%. The 3-month average of core PCE is annualized at 1.5%, and the 6-month average is 1.8%. Now, that's not the Fed's preferred measure. We all know that they like the lagging 12-month average. So that's not what they're using right now. But according to the most recent data, and the fact that some of the lagging indicators, like housing being a big one, is finally factoring into the data now, which is giving us that below 2% inflation rate. So there is a FOMC meeting this week, and obviously rates will remain unchanged, but the real question is what the messaging will be this week and over the next few months. And even though inflation came in lower, we still had a pretty strong GDP data. So in my opinion, that's enough to think that the Fed's going to stick to their guns on the whole it's premature to talk about cutting narrative. I still think they likely won't cut until June, mainly because the Fed has a history of waiting too long. But the market actually thinks the odds of just one cut through the June meeting is at 14%. So the market thinks that we're going to have at least 2 cuts by the end of the June or after the June meeting. So that remains to be seen. The next core PCE report, along with the 2 job reports before the March meeting, are probably going to dictate when the Fed changes their language to discuss cutting rates. I don't think we're going to hear that at all in this week's meeting, mainly because we saw what happened when they pivoted last year. That's when we got that huge rate drop, about 100 basis points in October through the end of the year. So I don't think that the Fed is going to change that messaging right now. I mean, why would they? We've already seen rates pull back, and real rates are really restrictive enough on the economy. So I don't think they want to rock the boat right now and have anybody, reaching at straws to figure out, whether or not they're cutting sooner than later. So all in all, I do anticipate this week's meeting to be mostly neutral. One interesting thing the Fed did say, though, last week is that they're ending the bank term funding program in March. They were clever about their wording because, they usually are, but while the program is ending soon, they didn't mention that what they were doing about the banks who've already borrowed, and banks can still get funding before the program ends in March. So that's going to be an interesting thing to see how they handle the current or the banks that have already taken money over the last 10 months, and then the people who are going to take it over the next few months before the program actually closes. So I do think they will probably end up pulling a rabbit out of a hat at the 11th hour like they usually do and extending that bank funding program, because if they don't, that will be problematic for banks, and that would hinder our ability to lend and other things. It would make lending likely tighter, because that means that banks would have to start paying back those funds, or they'd have to pay back all the funds. So I do anticipate that they will extend it, but they are ending the program. The other thing that's kind of interesting, they did this in the great financial crisis, is that they're actually going to require, as the program ends, they're going to require all banks to borrow in an effort to anonymize which banks are weakest. So like I said, they did this in the last downturn, the great financial crisis. They forced Wells Fargo to take a loan, even though Wells Fargo said, we're good, we don't need a loan. They made them take it because what they want to do is they want the larger banks to take some of this money, so that way you can't easily pinpoint where the weak spots are in the banking system or who the weak players are in the banking system. So interesting thing to watch out for. Now, in terms of financing and what our rate forecasts are, I know I've been giving those week over week, but for the most part, I am seeing rates getting lower, inching their way lower. Certain lenders are starting to reduce their spreads. There's still a pretty big difference. So, when rates were really low, the majority of lenders, you had these kind of core lenders that you knew were your most competitive lenders, and they were within, maybe 5 to 15 basis points of each other on any given program. Right now, we've cast a wide net. So I have certain lenders who are a lot more competitive for lower leveraged debt. So like at 50% LTV, it would be, or less, it would be the most competitive rates. And we're talking stuff that's over $1 million and preferably over $2 million. But the rates, I do have better rates under 50% loan to value. They go up a little at up to max 60. And then of course, max leverage, like if you can even get a deal to pencil at that in today's environment, like 70 or 75% loan to value, that would be slightly higher depending on the lender. So the lending landscape is still very much changing all the time. I just had another competitive lender come in the market this week. So it's always changing, and we just have to keep calling and making sure that, we're on top of who's most competitive for the time today. So if you have gotten quotes over the last couple of weeks, again, I just encourage you to reach out to your loan officer or reach out to me and get that updated, because things do change. And I know you're trying to make a lot of decisions partially based on what the cost of debt is these days. So that said, a lot of our bankers are forecasting. I've said this previously, but I see more and more articles. Like, for example, there was a CoStar article that came out that they are anticipating activity to be up marginally this year. Now, we do think that it's going to be weighted on the back half of the year, maybe even third and fourth quarter. So I do see specifically even multifamily that financing will increase, which means there will be more activity in the market. But I think we're kind of in this quiet zone right now while we're waiting for the Fed to actually start cutting. And banks are still a little bit uncertain right now as well, because there's a lot of talk about whether or not we're going to achieve this soft landing, which more and more, I think the market is not believing this soft landing narrative. Part of it has to do with all of the looming commercial real estate debt crisis that's coming up. There's going to be a lot of pain there. And not to mention that the longer the Fed waits to cut rates after March, the smaller and smaller probability it is that we achieve that soft landing. Now, no one's saying that we're going to have like a great financial crisis, recession, type recession. I know a lot of real estate investors were hoping for that, because that means that there would be a lot of deals on the market, but we just don't see that is going to happen. But I do see that some pain is coming. It does seem like we're going to have a recession. How deep and how difficult, we don't know, but we don't think that it's going to be like, as rough as the last recession that we had more than 10 years ago. So anyways, you guys, the week ahead, we have the Fed meeting this week. We have a jobs report coming out. But other than that, there's not a whole lot going on in the way of data and news and all that good stuff. So have a fabulous week. Like I said, reach out to me if you have any questions. I am underwriting so many deals right now. They're all trying to move forward, but I am underwriting a ton of deals right now. So if you have questions on a property, if you're looking at purchasing something, feel free to send it over. It's easy for me. I've underwritten thousands of deals by now, so it's very quick for me. I'd be happy to let you know my thoughts and what I'm coming in at for financing. Have a great week, guys.